but I'll leave you, Dennis, to start
Yes, thank you. So we are about to start, unfortunately, our last meeting, our last lecture with Professor Toporowski. But I hope that this will be the start to some more deeper and profound consideration of the issues concerned, because we are having lectures, and lectures suppose only a certain level of description, of analysis of ideas. So I do hope that, based especially on the questions and reactions we get from the audience, we may move further based on the foundations provided by Professor Toporowski to move further to consideration of these issues. And that's what we are going to do right now. And by the way, our next lecturer, Noemi, Professor Levy, is here with us from Mexico. Nice to meet you. So
good morning or good evening.
Yes, good evening actually in Moscow, and good morning, I believe, in Mexico. Good afternoon in Europe. Professor Toporowski, please.
Okay. Thank you very much for this warm introduction. I'm delighted to see here Noemi Levy. I realize that it must be quite early. No, it's about 9 o'clock in Mexico City. Not so bad. Let me say by way of beginning that I've put up in the chat function a link to a book that will be coming out in January. It's called Interest and Capital, and it's a book. The subtitle is The Monetary Analysis of Michał Kalecki. A large part, there it is. Thank you very much, Anton. This is a large part of what I have been talking about in the last 2-3 days comes from this book, and the book expands on it and explains much more. In particular, the last 1/3 of the book, the last section of the book deals with central banking. I think not that Kalecki wrote particularly much about central banking. He did mention it, but his general monetary analysis presents a very neat critique of and a neat understanding of current central banking. So for those of you that are more interested, who are interested in knowing more about this kind of monetary economics, there is more in this book. There's also another book which is going to come out next year, a book on international equilibrium and Bretton Woods, also coming out from Oxford University Press. This is an edited volume. One of the contributors to this is with us today, Noemi Levy. And this really takes, this book on international equilibrium takes as its starting point a very specific aspect of Kalecki's work, which is his critique of the Bretton Woods arrangements. And I think this is particularly relevant to today's lecture. And I mention it because, in fact, today's lecture is really a summary of the final chapter in this book on Bretton Woods. It's a chapter on the reform of the international monetary system. And this is what I would like to go to now. So, Anton, if you could remove this and let me share my screen with my lecture. Okay. Somewhere there is, oh, here it is. Okay, this is my fourth lecture on the reform of the international monetary system. What I will do today, talk about today, if I can just go through the main topics, I'll talk about the legacy problems, and I'll explain what I mean by the legacy problems. Then I'll look at different approaches to the reform of the international monetary system, the elimination of macroeconomic imbalances. Secondly, currency swaps, which are being used now. Thirdly, the increase in special drawing rights, which came through in August. And then I'll talk about some of the proposals to return to the Keynes plan, because this is a common feature of post-Keynesian discussions. And then finally, I'll conclude by making some remarks about international debt and liquidity management, where you may recognize some of the central issues that I was talking about in my earlier lectures. So let me start off with the legacy problems. And let me start off by explaining what I mean by legacy problems. But even before I do this, let me explain that the international monetary system consists of two elements. One is the system of international payments. This obviously depends on the convertibility of different national currencies. And then the second point, the second part of it is the balance sheet part of the system, which is the system of inherited credit and debt. This is what I mean by the legacy. And this inherited credit and debt is what requires what requires, sorry, the servicing and refinancing as we go along with the okay, here we are. Sorry, I was trying to get the photographs out of the way, the pictures of the audience out of the way, so I could see what I have on my screen. So this was the Minskian. It's very much a kind of Minskian distinction between current payments and the inherited debt structures. And the fundamental legacy problem is the problem of assuring payments while dealing with these legacy issues. And the legacy issues really mean servicing and refinancing this international credit and debt. Let me this is the practical dilemma of any attempt to reform the international monetary system. This is, as opposed to, well, I would contrast this to the idea that what the approach to the reform of the international monetary system should be to imagine how an optimum system would work, so that you start off with, you make a new start and you try and you forget about the legacy. In banking, this is similar to a kind of bad bank approach to the problem of banking instability. That you take all the problems, all the banking problems, put them into a bad bank, deal with that separately, and you make a fresh start without that overhang of problem debt and difficulties. So let's consider what these legacy problems are. And I take these in no particular order of importance, or I'm presenting them really in the order in which I've been working on them recently. First of all, there is the issue of the international debt of the low-income countries. These are the countries mainly in Africa that went through a most terrible process of what was called structural adjustment in the 1980s and the 1990s. And it gave rise in the 1990s when finally there was some enlightenment in the international or the multilateral financial institutions, the International Monetary Fund, the World Bank, and in the US government under Clinton. And there was there were initiatives to reduce that debt, the highly indebted poor countries initiative of the 1990s, and this was reinforced by the Sustainable Development Goals of 2000. More recently, the Addis Ababa action agenda. If you've been involved in development economics, you will know all these initiatives. They became almost a shopping list of the desirable outcomes for developing countries. But having reduced their debt considerably by around 2008 to 2010, the external indebtedness of the poor countries rose dramatically after 2013, from about 300 billion to almost over 500 billion in 2019, on the eve of the COVID crisis. A lot of this consisted of issues of euro bonds by low and middle income developing countries and by and emerging markets. Added to this were new structures of international debt, a huge increase in the foreign indebtedness of private sectors in middle income countries, in Latin America, and elsewhere, really in countries where there were weak capital controls or no capital controls at all. I note that of course, the biggest countries, China, India, also South Africa, have capital controls, but they're not very effective. I won't say more on this because I believe Naomi Levy will be talking about this later on. COVID effects. This is the COVID effects have been huge. There's been a major rise in the indebtedness of governments in rich countries and in poor countries. In many rich countries, the levels of government indebtedness relative to GDP now exceeds 100% of GDP. And there's been a jump in the indebtedness of poor countries from 29% of GDP in 2012 to 49% in 2020. Now, this may seem low relative to the rich countries, but let's bear in mind that these are poor countries, and whereas the rich countries have largely borrowed in their domestic financial markets, the poor countries have been borrowing abroad. The response to this, as far as the poor countries are concerned, has been a debt service suspension initiative agreed by the G20 governments in May 2020, May of last year. And this extended official debt payments for the 73 poorest country governments up until July 2021. And it's since been extended further. The problem, though, with this is that the G20 does not speak for all the official creditors, and China notably operates independently. And so it's not the G20 agreements. All of these agreements are partial and not very effective to some degree, but not very helpful at a time when governments need cash flow. They need money for replacement income for their citizens and to pay for medical care. There's rising expenditure demands on governments for the medical emergency and replacement income in employment. On top of which, of course, we've had in the last 2 weeks the COP21 discussions in Glasgow, in the neighbouring country here of Scotland, where even additional demands are being placed on governments to clean up emissions. Now, this comes at this is in the context of low export commodity prices, or commodity export prices. Most developing countries and to a very great extent the many emerging markets are dependent on exports of commodity raw materials, and thanks to high commodity prices, they managed to survive the debt crisis, the financial turbulence of 2008. But since 2014, international commodity prices have fallen by somewhere around 40%. If you just look at, in actual fact, they'd fallen much lower since COVID. They've recovered somewhat, but they're still substantially below what they were back in their most recent peak, at their most recent peak in 2014. Added to this is a further political difficulty, and that is the difficulty of populist pressures on governments to reduce aid to poorer countries. And I mean, I see this very obviously in the case of the UK, where Britain had legislated to provide 0.7% of GDP in foreign aid. With the advent of the present government, this has been cut to 0.5%, so that we now have in Glasgow today the paradox of my government advocating that, or urging governments to come to the assistance of poorer countries, while itself reducing its assistance. There's another technical aspect to this, and that is that too much of the assistance now also consists of allowing moratoria on debt payments, and this is and then charging this or putting adding this to the total of foreign aid. Now, this is deceptive because, in fact, if you write off a country's debt or you postpone it, you're not actually assisting in cash flow. If the government has the money to make the payment, then this may, give additional cash flow. But if it doesn't have the money anyway, then writing off the debt or postponing the debt payment or the interest is of limited assistance. For the Bretton Woods institutions and for fiscal conservatives and many of the private sector international financial or international banks, the solution to these difficulties is the elimination of macroeconomic imbalances, what are called macroeconomic imbalances. And what they mean by this are fiscal and trade deficits. If you talk to people in international banking, you ask them how do they assess risk, financial risk of governments that borrow in the international money markets, they will tell you that the key to understanding the financial risk is the scale of fiscal and trade deficits. If there are trade deficits, that's an indicator of risk. If you add to this fiscal deficits, then the risk is increased. So a lot of their strategies for stabilizing this situation, for eliminating this risk, consists of getting rid of these deficits. And the way they think about it is that they think about this in terms of savings, the famous savings identity, where saving is equal to investment plus the fiscal deficit, government expenditure minus taxation, plus the trade surplus, exports minus imports. And if the terms on the right-hand side of this equation are equal to 0, then you have a virtuous balance in which saving is equal to investment. This is, and if only governments can do this, then it will stabilize their position, and the rest can be negotiated away. This is certainly the theory behind the infamous structural adjustment programs of the 1980s. However, there are obstacles to eliminating imbalances in this way. First of all, it does not deal with the legacy of debt. It assumes you can put aside existing debt in much the same way that the group of 20 have done this, and then to be dealt with later, and then governments and countries, as they say, can live within their means. It doesn't deal with it doesn't deal with the legacy of debt. And in a situation of medical emergency, in a situation where the commodity price super cycle is trending downwards, the commodity price super cycle is really the kind of long cycle of commodity prices. Something I don't have time to explain this, but we're in the downward phase of this, and in this situation, it's not eliminating imbalances. Really still leaves governments and central banks, which are responsible for maintaining international payments, it still leaves them at risk. If they try to obtain a trade surplus to service or to pay down foreign debt, then it simply creates a deficit somewhere else in the system. This incidentally is why Minsky, as I think I mentioned yesterday, argued that the US needs to run a trade deficit, a permanent trade deficit. And if you want to understand it, international debt problems in a structural way, if you look at the incidence of international debt problems, you find that they correlate quite well with the US foreign trade deficit. Although they correlate inversely. When the US has a trade or reduces its trade deficit or moves towards a surplus, then you tend to have international debt problems. So, in any case, it is utopian to expect trade balance in all countries. And this actually is further discussed in this book on Bretton Woods that I mentioned at the beginning of the lecture. In fact, this was one of the Kalinski's criticisms of the Keynes plan, that it was based on the idea that equilibrium would arise when you had equilibrium of the trade balance. There is furthermore the idea that you need to eliminate the fiscal deficit. Well, this overlooks the distinction between internal or domestic debt and external debt, and I will come back to this. But I would just mention now that if the reason why the the fiscal deficit of the US or the UK or Germany is not a threat to the international monetary system is because this debt is being financed internally and not externally. But the situation is different in developing countries or emerging markets. Currency swaps, I mentioned them yesterday. Currency swaps the term currency swaps refers to swaps between central banks. And whereas the foreign exchange swaps that I explained yesterday are swaps between commercial banks. Now, these have been proliferating in recent in recent years. Why are they important for the international monetary system? Well, because when central banks engage in swap or repurchase agreements, they create additional bank reserves that they exchange with each other using repo agreements. And the Federal Reserve has been very active in creating these kinds of reserves to swap with other central banks. Commercial banks do much the same, only in their case, what they're doing is they're creating bank deposits that they exchange with each other using similar repurchase agreements. So it's a way of adding liquidity to the international monetary system. The central institution in all of this is the Federal Reserve Bank of New York. And what the Federal Reserve Bank has been doing really since the 1990s. It's the Federal Reserve Bank of New York because that is the section of the Federal Reserve System that runs the federal open market operations committee, and it runs the foreign exchange operations of the Federal Reserve System as a whole. And what they do is they announce the list of central banks that have access to swap facilities with them. And these are the central banks of Canada, Australia, New Zealand, Japan, the European Monetary Union, in other words, the European Central Bank, the UK, Sweden, Denmark, Norway as well. And among the emerging markets, Switzerland actually also, among the emerging markets, it's really only the central banks of Mexico, South Korea, and Singapore. So what's noticeable, a notable feature of this is that the developing countries are left out of this, these swap arrangements. And they were reinforced since COVID started in March 2020. Now, given that most of these, the main central banks with access are banks in countries where governments have no problem borrowing internally, actually the swaps have not been used very much. But they are one way in which the whole the international monetary system is, in fact, becoming an effective extension of the US dollar zone. It's reinforcing the dollarization of Europe. It reinforces the dependence of the international monetary system on US foreign policy. And we see this perhaps nowhere more clearly than in the case of then when Donald Trump was in the White House, and Donald Trump operated very freely with sanctions on governments with which he disagreed. And whatever the rights or wrongs of his disagreement, it meant that US banks, US commercial banks, were unable to extend these swap facilities to banks in those countries. It's one of the reasons why, for example, in the case of Iran, if we take the case of Iran, it's one of the reasons why European governments, although they took a different view to that of the United States over the nuclear agreement with Iran, they had to, European governments have been forced to, or European companies have been forced to go along with American sanctions, because otherwise European companies would not be able to get borrowing facilities even from European banks, because European banks are so dependent on US dollar financing. Special drawing rights. This is special drawing rights for a basket currency held by the IMF. This is a special, a currency which was issued or first in 1969. There was a new allocation agreed and made on the 23rd of August of this year, distributing $650 billion dollars worth of special drawing rights, of which most went to the advanced economies. The emerging markets got just under just over a third of this allocation, and the low-income countries got 21 billion, of actually a very, very small amount, and that compares with what the Russian Federation was allocated, which was 17.6 million. Unfortunately, there are arguments as to how helpful this is in the present circumstances. In fact, special drawing rights still make up less than 3% of non-gold reserves of central banks, foreign exchange reserves. Dollars make up more than half. So this special drawing rights issue is really quite small. It mostly benefits the rich countries. Now, one of the difficulties is that to issue new special drawing rights it requires the agreement of the board of the International Monetary Fund, and effectively the agreement of the US government. This is a political process which makes it very, very difficult for the International Monetary Fund to expand supplies of these special drawing rights in order to regulate liquidity in the international monetary system. They may only be used for payments between governments and the International Monetary Fund. I guess in some respects they may be helpful because they would free up dollars from reserves for use in more general international financial circulation. But this would only really apply to governments that had significant dollar reserves. It's not, so that there are arguments as to how useful this is. An alternative which has been canvassed quite quite widely in post-Keynesian circles is a return to the Keynes plan. This advocated in America by Paul Davidson, in the UK by Robert Skidelsky. And the advantage of this is that Keynes's idea of international currency, known as the Bancor, which would be linked to the scale of international trade. His idea was it would provide a fund which would be much larger than the present quotas or the present special drawing rights allocation. And if we look at this problem within the framework of what Keynes was arguing about, it's certainly an advance on the present situation. However, it overlooks an important part of the 1944 legacy that has changed dramatically since 2020, between 1944 and 2021. And this is that 1944 was towards the end of the Second World War, at a time when international payments had effectively been taken over by governments. And governments had also nationalized or taken control of the foreign assets and liabilities of the private sectors in their countries. So in effect, the governments were controlling private foreign payments. This actually is no longer the case for many countries. There are even countries where there are capital controls. You can find that there's considerable equivalent of private foreign debt. I mean, even in a country as regulated as China, there is private foreign debt that arises because of through the financial markets in Hong Kong. This overlooks the opposition to the Keynes plan from the US in 1944. Harry Dexter White and John H. Williams, who put forward different plans, were rightly saw the Keynes plan as being not just an effort to create a more just international monetary system, but they also recognized that it was an effort to sustain the financial position of the British Empire. So there were politics involved in all of this. And there was also, in addition, the opposition from many of the developing countries. And I would just mention Kalecki and Raoul Prebisch, who opposed the plans and opposed the Keynes plan because they believed that it didn't take into consideration the position of the developing countries. And partly as a result of this, the Bretton Woods Agreement was by no means global. And this is why I think that what one is left with, and this I'm coming to the end of my lectures now, is that the what we're left with is how to deal with international debt and how to manage the liquidity of the international monetary system within the present limitations, within the limitations of existing institutions. So I'll conclude by making certain suggestions towards stabilizing the international monetary system. First of all, I think that governments need to maintain existing levels of non-financial expenditure. This is absolutely vital in order to prevent deflation and to prevent the default by the private sectors in their own home countries. Why is this important? Because if deflation takes hold, then it will spread to other countries through the system of international trade and payments. I think this is especially important now because we have a situation where we have a situation where governments are under pressure to reduce the debt levels. There's a belief that the debt legacy of COVID is insupportable and must be reduced. Attempts to reduce that debt should be, by reducing expenditure, should be avoided. Additional expenditures needed should be made for COVID, for care, for income replacement and recovery, and additional expenditure is also needed for climate change. Oh, I can't. Okay. This should be paid for by increasing taxes on wealth and higher incomes. This was Kalecki recommends in his work on developing countries, but it's more generally applicable. And this is not just because Kalecki was and most of us, I guess, are keen on redistribution from the rich to the poor and believe that the rich should pay more. Even putting aside the arguments of justice and fairness and equity, there is a more technical economic argument behind this, and that is that if you impose higher taxes on wealth and on higher incomes, what you do is you influence the liquidity of the wealthy and people with higher incomes, but you don't affect their expenditure. Whereas if you levy taxes on median or lower incomes, then you are actually squeezing expenditure. Fiscal deficit, a third element of this should be that deficit financing should be done in domestic markets at long-term maturities. Very important, it should be done through debt, through domestic debt, because governments can set the terms for that domestic debt through the kind of operations that I was talking about yesterday. Long-term government bonds serve as the basis for financial development, and the sale of long-term bonds is also a way of absorbing excess liquidity from financial markets to prevent dollarization and exchange rate instability. This is a particular issue for emerging markets and for developing countries. That if you, unless those bonds are, unless money is tied up in those bonds, then what would tend to happen is that as the government spends the money and makes the extra expenditure, the financial markets become more liquid. They may become too liquid, and then if they become too liquid, then there is a problem of capital flight, dollarization, and exchange rate instability. But this is the fundamental problem of the monetization advocated by some economists. And what this requires is a permanent policy of central bank open market operations, buying and selling bonds to regulate liquidity in the domestic financial system. Foreign aid should certainly be increased in order to maintain expenditure in the less developed countries and to prevent default in private and government sector. The difficulties with this are really that domestic borrowing has been discouraged by the excess liquidity in the international monetary system, especially since 2008. I think I already mentioned yesterday that quantitative easing has really flooded the international monetary system with liquidity, and this has given this is one of the reasons why it's become so easy for governments that are otherwise very, very poor to be able to issue euro bonds in circumstances where there would naturally be some reluctance to lend to those governments. Plus, I think there's a doctrine around in development economics. It's always been there since before the First World War, which is the idea that the poorer countries are poor because they don't save enough. There's a saving deficiency in poorer countries. This comes from classical and neoclassical economics, but you find this also in the work of even post-Keynesian economists like Tony Thorwall. In practice, what one needs is an institutional mechanism that for converting excess foreign borrowing into domestic currency debt. Something like this is needed. If you in the late 1980s, there were governments that used capital inflows to refinance their government debt from foreign currency, from dollars into domestic currency. But unfortunately, the way in which this was done, if you do this through through a kind of market mechanism, what it did in Mexico was it burdened the Mexican corporations that were privatized in this way with foreign debt. So the government avoided a crisis or eased its financial burden in the early 1990s, but it merely transferred the burden onto the private sector, and which suffered in 1994, 1995. So I will finish off there. I think we still have a certain amount of time. Professor Lezi can tell you more about what happened in Mexico around this time. In fact, she knows much better than me. Okay, so I'll finish there.
Thank you.
Oh, yes. Oh, yes. My conclusion. My conclusion is that I think that all global solutions have utopian elements, in part because there is the politics behind it all, which I haven't spoken about much. And I think that regional solutions may work better. For example, the European monetary system, with if it was reformed, with a reformed franc zone. Okay, I'm finished. Thank you very much.
Thank you. Please, questions. Georg, please.
I'm just clapping, not a question. Thank you.
Ah, sorry.
Oh, I see.
I mean, you should, not sorry, but thank you.
Thank you very much thank you very much for the clap.
For the clap. But what about questions before we start clapping?
Yeah, I can see Gunnet with clapping as well. Thank you.
Yes, I see. Okay.
Sorry to interrupt. I'm particularly clapping at the conclusion, because it coincides with the views that I support most, views that are always articulated so eloquently by Samir Amin, the views about delinking, you know, the global south engaging in its own terms with the global system.
Yeah, yes, I agree.
Okay, but as the audience start to think about questions, may I ask you, did I get it right that the introduction of the swaps system, of the swaps mechanism, effectively contributed to the spread of the influence of dollar, to the dollarization of the global international system?
Yes, there is an excessive dependence on the US dollar in the international monetary system, and this has two disadvantages. One is the political one, that it really is not, you know, if you have someone like Trump in the White House, then it does cause difficulty. It's hegemonic and imposes policies on the rest of the world. And secondly, because I'm not sure that the US necessarily the US financial system necessarily operates in the interests of the whole world. There is the US Federal Reserve has to follow the to some degree policies, has to follow the interests of the United States, and you know, and actually for the same reason that other countries should also have monetary systems which are in tune with their interests. So it's a problem. But I mean, the dependence on the US dollar, I think, is excessive dependence is I think widely recognized, and you know, even as a danger to the stability of the international monetary system. If you let's say take the case of Japan, the Japanese monetary system is over dependent, I think, at the moment on US dollars, but it's to some degree something of their own making.
I see. But what then are the perspectives, so to say, of euro, for example, or for that matter of pound? Can they be used as kind of substitute for at least partially for dollar? Or should we try to invent some regional, let's say, currencies like you mentioned, franc zone, something of the like?
I suppose what one could. I mean, the advantage of regional solutions is that they it's easier to make regional agreements than a global international one, as the people in Glasgow realize today, and that you know, this is a and this is where I think the solution lies. But I also want to say that we need to see this in perspective. And it's in the perspective that there are governments face a number of very serious real problems. And I'm not sure that changing the monetary system will solve all of these problems. What the monetary system can do is it can make it easier or more difficult to deal with legacies of debt, legacies of credit and debt, but issues like the real problems of the world, like climate change, poverty, and so on, they need you know, the monetary system is not a factor, although it may be an obstacle. And if you fall into the hands of, as the developing countries did in the 1980s, you fall into the hands of an international monetary fund that is determined to restructure economies in a way that is contrary to their interests, then the situation would be very, very bad. So a monetary system can make the situation worse, but it can't make it better.
I see. Okay, thank you very much. Ilhan, please.
Thank you so much. I hope you can hear me.
Yes.
Yes.
My question is about the capital controls. Some of our post-Keynesian colleagues, as far as I observe, not only in my ex-home country, Turkey, but also in Europe, they have a sympathy for the nation states, maybe because of the overemphasis on fiscal policy.
Yeah.
And most of them are in favor of capital controls and so on, because as we have experienced, especially hot money inflows into the developing countries has destabilized these countries financially. But I agree with Basil Moore. He is also against the capital controls, and he says that capital controls alone cannot provide the long-run independence, and because financial actors especially will gradually eroded the controls over time as they learn how to get around them. My suggestion would be not such authoritarian controlling policies, rather macroeconomic policies to definancialize the economy, which means making profit over production to make it more productive and seducing, instead of making profit over financial transactions. But since if we are in favor of a capital controls, then we cannot delegitimize other border controls such as flow of people, migrants, and so on. I would like to hear your thoughts about that conflict, especially the post-Keynesian approach to the capital controls and internalization.
Yeah, I actually agree with you about capital controls. Also, I agree with Basil Moore. I don't think that they're a practical alternative. It's possible to introduce them in wartime because it's very obvious who the enemy are, and and you need to have capital controls to stop people from passing money to the enemy. But this is not. It's not the case in peacetime. So I also don't think that they work very well. I mean, if you look at I've already mentioned China, which has the big hole in the capital controls, where Hong Kong is. If you take South Africa, the capital controls simply mean that large corporations can move their money around, but not smaller businesses, and not households as a way of penalizing smaller businesses. So I don't think it could work. I'm not sure I'm not sure what you mean by definancialization, but I certainly think that the central banks needs to be more active in their financial operations to ensure that or to manage liquidity, and that to manage liquidity and also to manage the yield curve. But then apart from this, you then have to decide whether much more important issue is, do you have private sector development or do you have public sector development? That's that really is a far more relevant question. Okay, I can see a question.
Yes.
Could you comment on the ordoliberalism way of thinking that has been followed in the EU, and the issue of optimal currency area? I know I haven't really studied ordoliberalism and the contribution of ordoliberalism to the way in which the monetary institutions of the European Monetary Union have been set up, I think has not been good, and in fact has has fossilized, ordoliberalism fossilized monetary thinking within Central Europe and within the monetary institutions. The problem with the optimal currency area theory is that it's been linked too strongly to the issue of labor market flexibility, and actually optimal currency area theory has, if you look at the discussion between Schumacher and Kalecki, for example, on regional currency theory, it was really much more concerned with analyzing how far countries, the structure of countries' economies complement each other, so you can have a proper division of labor, which makes the free trade efficient. If you have the system in the EU, which operates in a profoundly deflationary way, it's really doesn't create an optimal currency area. It simply it creates a zone in which there is more, there's political pressure for national solutions and protectionism, and I think that I think is bad, because Europe does benefit from having a common currency. The key advantage of having a common currency, and this was recognized by Robert Mundell, is the pooling of reserves. If you can pool reserves, then you can this can stabilize your exchange rate, and it's an advantage. It's a monetary advantage. The notion that it has anything to do with labor markets or the condition of the labor markets was, well, this was Mundell's first thought. He had second thoughts afterwards. He did at least broaden his view. Okay.
I think there are no more questions, which makes me, which compels me to finish our meetings with Professor Toporowski, the meetings which I personally was awaited very, very much over past 3 days. Professor Toporowski generously shared with us many ideas, many thoughts, many notions we may think, we may discuss, we may debate, and we are grateful to him. But we are also grateful, I think, to him because he gently guided us to the weekend, especially in a certain part of the world, and we rightly deserve, therefore, our evening tea, or perhaps not even tea. Thank you so much, Professor Toporowski, and we will be waiting for the continuation of our meetings, our lectures next week. Thank you very much to all those who present.